Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need to be truly well-informed. Today, we're plunging into a field that's, well, as exhilarating as it is complex: quantum computing. And our mission: to take a deep dive into IonQ's Q2 2025 earnings analysis. It's a fascinating look at a company trying to carve out its place in the future that's still very much being built.
Yeah, absolutely. And to help us navigate this, we've pulled together a pretty robust stack of sources. We're relying on IonQ's official earnings press release, naturally verified real-time market data right from the markets, and a range of insightful analyst reports, too. This kind of blend gives us both the raw numbers and that crucial broader market context, you know?
Exactly. Our goal here is to move beyond just reporting figures. We want to identify the most important nuggets of knowledge and truly help you understand the story behind IonQ's recent performance and maybe where they're heading. We'll be using a clear 5-part framework to guide our conversation, so you'll have a straightforward roadmap through this deep dive. All right, let's jump right in then. Now for slide 1, the at-a-glance scorecard. When you first look at IonQ's Q2 2025 results, they present a really stark dichotomy. It's kind of striking. On one hand, you've got absolutely exceptional top-line growth, really impressive. But on the other, a substantially larger bottom-line loss than many expected. It really is a classic growth-at-all-cost strategy playing out in real time with this company. So let's talk about the revenue first. IonQ reported total revenue of, $20.7 million for the second quarter. That didn't just meet Wall Street's expectations, it significantly exceeded the consensus estimate of about $17 million. We're talking an impressive 15% beat over the high end of their own prior guidance. That's pretty good. And get this.
It's a robust year-over-year growth of over 81% from Q2 2024. That's serious acceleration. Shows they're winning significant contracts. But then you look at the earnings per share, or EPS, and it's a very different picture, but jarring, actually. The company reported a GAAP diluted loss per share of 0.70 cents. This was a substantial miss compared to the consensus estimate, which was around D113 cents. Big difference. We're talking about a dramatic, 288.9% year-over-year increase in diluted loss per share from FIR 118s in Q2 2024. And the net loss attributable to IonQ. That skyrocketed by over 370%, reaching $176.8 million from about $37.5 million just last year. So incredible revenue, but also a huge loss. It begs the question, how are analysts reacting to this mix?
It's a great setup because what's fascinating here is the analyst sentiment, despite those, deep losses. Initial commentary before the earnings release often leaned towards maybe a hold rating, acknowledging the risks, the high valuation in such a nascent industry. But post-release, the consensus among analysts shifted quite significantly to a buy. A remarkable 63% recommending a strong buy, actually. This suggests that analysts are clearly prioritizing IonQ's strategic execution and its long-term potential in this high-growth market. They're looking past the immediate profitability concerns, focusing on the quantum computing potential. They're playing the long game, it seems. So let's dive into the story behind the numbers, why EPS and revenue diverged. Because it's not immediately obvious. First, it's really crucial to understand diluted earnings per share, EPS, for a company like IonQ. Simply put, it's the company's profit or loss allocated to each outstanding share of stock. The diluted part means we're accounting for all potential shares that could be created maybe from employee stock options or warrants, things like that. For IonQ, which uses equity stock extensively for compensation and financing, this diluted figure gives us the most conservative view and, frankly, probably the most realistic view of their per-share profitability. It's why it's so relevant here. Now, the primary driver of that massive net loss, it was a very deliberate, very dramatic increase in total operating expenses. They skyrocketed by over 200% year over year. Just huge. From about $60 million in Q2 2024 to an astonishing $181.3 million in Q2 2025. This surge was led by two key areas: research and development, R&D. Those expenses grew over 238% to $103.4 million. This really reflects their intense focus on accelerating their tech roadmap, think breakthroughs in qubit stability, error correction, bigger quantum computers faster than anyone else. And secondly, general administrative G&A costs. They increased an astounding 268.5% to $48.1 million. This includes things like salaries for corporate expansion, and importantly, costs from integrating recent acquisitions like Lightsynq and Capella. Those integrations aren't cheap. The second contributing factor, though less dominant in the spending, was shareholder dilution. The weighted average diluted share count, that's the denominator in the EPS calculation, it rose by nearly 19% year over year. This increase is a direct result of the company issuing new stock, both to raise capital and, importantly, to compensate employees. While the massive net loss was the main reason for the EPS decline, this dilution means that loss is spread over a larger share base. It's kind of a necessary trade-off when you're funding ambitious, rapid growth like this.
So if we bring this back to our at-a-glance scorecard, it's really clear now, isn't it? These two headline figures, the soaring revenue and the deep EPS loss, they're not contradictory at all. In fact, they are truly two sides of the same strategic coin. It clicks into place. IonQ is executing a classic growth-at-all-costs strategy, heavily funded by the capital markets, no doubt about it. Impressive revenue beat demonstrates that this strategy is successfully translating into real commercial wins. They're landing deals. While that deep EPS miss reflects the immense cost of that strategic investment into the future. It's a high-stakes bet, for sure, but one they seem absolutely determined to win. Okay, with that top-level view in mind, let's now peel back another layer. Let's dive into what's driving their profitability, or perhaps their current lack of profitability. Moving to slide 2, the engine of profitability. It's super important, I think, to look beyond that headline net loss and dissect profitability at different levels, because a single number can be very misleading, especially in a company like this one.
Absolutely. Couldn't agree more. Let's analyze the gross margin first. This metric tells us about the profitability of their core business activities before overhead, essentially how efficiently they're delivering their services. In Q2 2025, IonQ generated a gross profit of $12.4 million on that $20.7 million of revenue. That gives them a gross margin of almost 60%, which is pretty decent. Now, that's a significant improvement from Q2 2024, when their gross margin was about 51%. This year-over-year improvement is a crucial positive indicator. It really is. It suggests that as IonQ scales its operations, it's actually becoming more efficient at delivering its quantum computing services. The cost to generate each dollar of revenue is decreasing, which, points toward a potential path to profitability down the line if they can get those larger operating expenses under control eventually. That's the big if. However, when we look at the operating margin, well, it tells a very different story, as you might expect. This metric includes all operating expenses, not just the cost of revenue, the whole shebang. In Q2 2025, with an operating loss of $160.6 million, IonQ's operating margin was a deeply negative 776%, minus 776%. This is a sharp deterioration from Q2 2024, when it was negative 430%, so it got significantly worse. This dramatic decline in operating margin clearly illustrates the scale of IonQ's strategic investments. The benefits of their more efficient service delivery, which we do see in the improving gross margin, were just completely overwhelmed by that massive 200% increase in overhead spending on R&D, talent acquisition, corporate expansion. It's like they're building a super efficient car engine, but simultaneously investing heavily in a brand new factory to build 1 million more cars. So overall costs are just soaring.
Okay, so we've got the gross margin looking solid, improving even, but the operating margin is deep in the red. How do we square that circle? This is where it gets really interesting, I think, because IonQ's management introduces something called adjusted EBITDA. They seem to emphasize this metric. What exactly is that, and why is it so crucial for understanding their view of the business?
That's a critical question, definitely, because this is where the nature of their spending really comes into focus. GAAP, or generally accepted accounting principles, that's the standard framework for financial reporting. It gives us the complete conservative picture. But non-GAAP measures, like adjusted EBITDA, they exclude certain items that management believes don't reflect the sort of recurring operations. For IonQ, the gap between their GAAP net loss of $176.8 million and their adjusted EBITDA loss of $36.5 million is huge. It's a whopping $140.3 million. That gap tells us a lot about what management considers core versus non-core or temporary costs. So the key adjustments bridging this gap are primarily stock-based compensation at $99.2 million, almost $100 million. This is the single largest adjustment, and it's a non-cash expense. It represents the value of stock options and awards granted to employees. While it doesn't consume cash right now, it does dilute existing shareholders over time. IonQ uses this as a crucial tool to attract and retain elite talent in the hyper-competitive quantum industry. Their CEO even emphasized this, talking about hiring towering figures, basically, the absolute best minds in the world. You need stock for that. Then there's the change in fair value of warrant liabilities, another $39.6 million. This is a non-cash accounting loss tied to warrants issued as part of financing activities. Management excludes this because, well, it's unrelated to their day-to-day operations. And finally, acquisition transaction costs of $14.1 million. These are direct cash costs for recent and proposed acquisitions. Real money going out the door for deals. So, synthesizing all this on profitability, we see a nuanced picture, right? The improving gross margin suggests the fundamental business model is sound and potentially scalable. They're good at what they do. However, the deeply negative operating margin and that large GAAP net loss clearly show a company in a phase of massive, deliberate investment.
Pouring money in.
The adjustments made to arrive at adjusted EBITDA reveal that the majority of that headline loss is driven by non-cash expenses like stock comp and strategic costs tied directly to their long-term plan. It makes you wonder, doesn't it? How long can a company sustain this level of investment before the market demands actual profit? It's a real high-wire act.
That's a really sharp insight, and it ties right back to that growth at all cost idea we started with. Now, many companies break down their revenue by specific business lines. Is it hardware, software, services? IonQ operates differently, it seems. This raises an interesting question. Is their performance being driven by a single engine room, or are there distinct segments pulling their weight? Time to zoom in on our next section. Slide 3, the engine room business segment performance. What's going on under the hood?
That's an excellent question, and it's one where the earnings report actually clarifies something important. IonQ reports its financial results on a consolidated basis. Simple as that. What that means is they don't provide a public breakdown of revenue or operating income by specific business segments. So you won't find separate numbers for, say, quantum computing as a service or direct hardware sales or maybe professional services related to quantums all lumped together. And this strategic choice, well, it makes a lot of sense when you look at their overall narrative and their recent corporate actions. Their acquisitions like Lightsynq for photonic interconnects, Capella for space-based quantum networking, and the proposed deal for Oxford Ionics for their specific chip tech, they're all aimed at creating a single, deeply integrated technology stack. It tells us that for IonQ right now, their entire focus is on building one cohesive, powerful quantum platform. That's the goal. They're not trying to optimize separate divisions yet. It seems every dollar, every acquisition is about strengthening that single unified quantum stack. It means we really have to analyze them as one integrated unit, which is, a strategic choice many cutting-edge tech companies make in their early rapid scaling phases. It's all about building that foundational technology first, not diversifying product lines just yet.
Okay, that definitely puts their overall strategy into clear perspective. It's all about the integrated stack. Now, to fund all of this ambitious growth in these acquisitions, well, you need serious capital, serious cash. So let's shift gears and look at how they're managing that financial side. Next, we move to slide 4, financial strength and shareholder rewards. For IonQ, their balance sheet truly stands out. It's best described as a fortress of capital, I think.
That's absolutely right. Fortress is a good word for it. IonQ's primary strategic asset is its formidable balance sheet. It's characterized by massive liquidity and, critically, a complete absence of debt. As of June 30, 2025, the company held about $140 million in cash and cash equivalents, plus another, $516.7 million in short and long-term investments. So this combines for a total liquidity pool of nearly $657 million. That's a lot of dry powder right there. But here's where it gets really interesting and why it's truly a fortress. More significantly, the company highlighted a pro forma cash equivalents, and investments balance of approximately $1.6 billion as of July 9, 2025. Now, this figure accounts for the proceeds from a massive $1.0 billion equity offering that closed after the quarter's end, just after. This immense cash reserve provides the company with a multi-year operational runway. They can fund their R&D and expansion plans for years without needing to tap the markets again soon. They've essentially secured their funding, giving them huge flexibility. And their financial stability metrics, they just confirm this strength. They have a debt-to-equity ratio of 0.0, zero debt, which means IonQ is funded entirely by shareholder equity. This frees them from the cash strain of interest payments, which is huge for a company burning cash on growth. And their current ratio is exceptional, 7.76x. Demonstrating overwhelming short-term solvency. Just to put that in perspective, they have almost $8 in current assets for every $1 of current liabilities. A typical healthy company might aim for around 2.0x, so 7.76 is incredibly strong. This financial strength isn't accidental. It is the direct outcome of management strategy to leverage its stock, raise capital, and build that war chest to fuel the high burn rate strategy.
So given all that capital, $1.6 billion pro forma, it's pretty clear they're focused on reinvestment, right? But what about their capital return policies? We should touch on that. Are they paying dividends or buying back shares to reward investors in the short term?
Yeah, good point. A quick review of their cash flow statements confirms that IonQ did not use any cash to pay dividends or repurchase its own shares during this period. None at all. And this is both expected and, frankly, appropriate for a company at IonQ's stage of development. It would be weird if they were. As a pre-profitability, high-growth technology firm, their primary objective is value creation through innovation and market expansion. Pure and simple. All available capital is being reinvested back into the business. R&D, acquisitions, scaling up. For investors, the potential reward comes not from immediate cash returns like dividends, but from the prospect of significant long-term stock price appreciation. If the company's strategic bets ultimately pay off, it's a pure growth play, not an income play.
That makes perfect sense for a company in such a nascent, high-potential industry. It's all about investing for the future. Okay, finally, let's look at slide 5, the road ahead management's outlook and key takeaways. This is where we synthesize the results with management's forward-looking statements to really understand where IonQ thinks it's headed.
Right. And management's tone in the earnings release was, well, unequivocally confident and very strategically focused. CEO Niccolo de Masi framed the quarter as a major success on multiple fronts. He stated, and I'm quoting here, "I am pleased to report that we beat the top end of guidance for Q2 revenue by 15% and strengthened our balance sheet via the largest equity investment from a single institution in the quantum industry." Pretty bold statement. He didn't stop there either. He emphasized their technological ambitions, declaring, via our closed acquisition of Lightsynq, along with our proposed acquisition of Oxford Ionics, we've created the most advanced and powerful quantum computing and networking roadmap in the world. Quite a claim. Very confident. And this confident narrative is backed up by some concrete financial guidance that points to continued, maybe even accelerating growth. For the third quarter 2025, IonQ expects revenue to be between $25 million and $29 million. The midpoint of that range, $27 million, would represent a significant 30.4% sequential increase over Q2's strong results. That's fast growth, quarter over quarter. And for the full year 2025, IonQ actually raised its revenue outlook to a range of $82 million to $100 million. This is a notable increase from their prior guidance of $75 million to $95 million. It signals that management's visibility into its sales pipeline has likely improved significantly. They're seeing clearer demand ahead.
Okay, so let's tie this all together then with the summarized key takeaways from the report. What are the big things you should remember from this deep dive?
Okay, takeaway number 1, aggressive growth strategy validated by revenue beat, but at a high cost. Pretty straightforward. IonQ's Q2 revenue grew that impressive 81.8% year over year, crushed consensus estimates, validating its commercial strategy. They can sell. However, the success was funded by that massive surge in operating expenses, leading to the GAAP EPS loss of 70 cents, way bigger than Wall Street expected. Second takeaway, the balance sheet is fortified into a strategic war chest. This is key. With that pro-forma cash and investments position of $1.6 billion and zero debt after the big equity offering, IonQ has secured a multi-year operational runway. This financial fortress is a strategic weapon. It lets them fund their ambitious roadmap, potentially outspin competitors. Though, important to remember, it has come at the cost of significant shareholder dilution. Third, profitability metrics reveal a deliberate investment phase. Don't just look at the headline loss. While that loss is jarring, the deeper analysis shows improving gross margins almost 60% in Q2, suggesting the core business is becoming more efficient with scale. The massive GAAP loss is dominated by things like non-cash stock-based compensation, nearly $100 million, and other strategic expenses. It paints a clear picture, a company intentionally sacrificing near-term profit to invest heavily in talent, tech, and acquisitions for long-term dominance. And finally, takeaway number 4. A confident outlook signals accelerating momentum. Can't ignore this. Management's decision to raise its full-year revenue guidance and guide for strong sequential growth in Q3 is a powerful signal of confidence. It suggests that the current business momentum, driven by commercial and government contracts, isn't just sustainable, but is actually expected to accelerate through the rest of the year. So the final narrative from this report, it's very clear, I think. IonQ's second quarter was a dramatic and clarifying display of its core strategy. They're leveraging their equity, their stock, as currency to fund a full-throttle sprint toward technological and market leadership. That's the game plan. The impressive $20.7 million revenue beat, that was a tangible outcome, proving they can secure big contracts and turn technical promise into financial results. This top-line success, however, was necessarily shadowed by that staggering GAAP loss, a loss driven by the very investments fueling the growth-soaring R&D acquisitions and the significant non-cash costs of attracting elite talent. By raising over $1 billion and building that $1.6 billion war chest, management has made an explicit, unapologetic choice. Accept massive near-term losses and dilution as the necessary price for building what they hope will be an insurmountable competitive moat. The strong, raised guidance serves as management's definitive signal to investors. This high-stakes bet is beginning to pay off. Focus on the accelerating revenue, not the current investment-driven losses. That's the message.
And that's really why this structured analysis is so valuable for you, the listener. It helps you move beyond just the headlines, identify those underlying drivers, assess the financial health of that fortress balance sheet, and truly understand management's outlook. It gives you a much deeper understanding of the true story behind IonQ's performance and where they might be heading. So, thinking about IonQ's growth at all costs strategy, what does this approach teach you about evaluating other companies? Especially those in nascent, high-potential industries where maybe that long-term vision clearly overshadows short-term profitability. It's definitely something worth pondering. Okay, before we wrap up, we have some important disclaimers to go through.
Yes. This report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. Please remember that. All investment decisions should be made based on your own research and always in consultation with a qualified financial professional. Also, this report was generated by an artificial intelligence model. Please independently verify all information before making any decisions based on it.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.